Chapter 6, Homework Problem 4, is an example of our revenue recognition principle, Step 3, determine the transaction price. This is what happens when we have payments in the future. I also chose this problem because it's a great introduction to our computer lab next week, the time value of money. Notice that we are not going to use the tables. We're going to use either formulas or Excel because the hyperlinks for the tables are very, very old-fashioned. So we have Arctic Cat sold Seneca Motorsports a shipment of snowmobiles. The snowmobiles were delivered on January 1st, 2021, and Arctic received a note from Seneca indicating that Seneca will pay Arctic $44,000 on a future date. Unless informed otherwise, assume that Arctic views the time value of money component in this arrangement to be significant and that the relevant interest rate is 8%. We are not going to use the interest charts, although at the end of the problem I may demonstrate how to use the interest charts. So in requirement number 1, assume that the note indicates that Seneca is to pay Arctic the $44,000 due on the note on December 31st, 2021. Prepare the journal entry for Arctic to record the sale on January 1st, 2021. So we have a formula here for the value today, or the present value, is the future amount divided by 1 plus the interest rate to the power of, in Excel, power is this little hat symbol, so I'm going to use that to the power of. For today, I'm going to say the number of years for this problem. When we go over time value of money, it's actually the number of compounding periods. So for example, if we were using a car payments are monthly, so we would use the number of months instead of the number of years in this formula. But I'll go over that when we're in Chapter 5. So for right now, we have to the number of years. The reason for that is we can work it the opposite way. Let's say the number of years is 1. We'd have our present value is the future amount divided by 1 plus the interest rate. Well, if we take the present value and multiply it by 1 plus the interest rate, we get to the future amount. So this is just solving for a different amount. So let's look at requirement number 1. So for requirement number 1, there's a couple of ways that we can calculate that present amount. The first way that we can calculate the present amount is to take the 44,000 and divide by 1 plus 8%. Now, 1 plus 8%, 8% is 0.08. So 1 plus 8% is 1.08. But I will show you that using Excel, I just put the parentheses on that just to identify the number. We're just taking 44,000 and dividing by 1.08. Now in Excel, if you didn't know that 1 plus 8% is 1.08, you can actually put in the formula in Excel as 44,000. Now I would need the parentheses. That's kind of why I put them in before, because I was thinking ahead. 44,000 divided by open parentheses 1 plus 8%. So I could have used the 1.08 in the formula, so I could have done 44,000 divided by 1.08. That would work. But in this one, I'm going to use 44,000 divided by 1 plus 8%, assuming that I'm not very good in my decimals, because the only thing that's important is the answer. So we get 40,740.7, and they told us to round our final answers to the nearest whole dollar amount. We can actually even use Excel to round it if that's what we want, but we know that's 40,741. Now, there's another neat way that we can do this using the PV function. So what I'm going to do right now to get the exact same answer is I'm going to click on cell D6, and I'm going to click on Formulas, and notice there's an entire group in the function library. There's an entire group for financial, and I'm going to scroll down, and I'm going to look for PV. PV returns the present value of an investment, the total amount that a series of future payments is worth now. So I'm going to click PV. My rate is 8%, so 0.08. I could put that in as 0.08, or I could put it in as 8%. In this case, the number of periods is 1. And I'm going to skip over the PMT, because the PMT assumes that you're getting the payment each period. What I'm going to do is skip over to the future value. I will explain this when we get into the computer lab next week. Now, if I put in 44,000 in the future value as a positive number, I'm going to get a negative answer. So to get a positive answer, I just put in a negative 44,000. And notice I'm getting the exact same answer, 40,740.7. So I click OK, and once again, it's just two different ways to get the exact same answer. Moving on, let's do requirement 1 and 2. They want us to prepare the journal entry for Arctic to record the sale, and then to record collection of the payment. Now, let's record the sale from the point of view of Arctic Cat, who is the seller. So Arctic Cat is going to have a notes receivable. Accounts receivable doesn't have interest, so once we have interest, we have a notes receivable, not an accounts receivable. And we never record anything that's going to happen in the future. We're going to earn the interest over the next year, so the note receivable right now is 4741, and the offset is to credit the sales revenue. Now, later on for the collection, we're going to get cash of 44,000. So first of all, why did we get the cash of 44,000? First, it takes care of the notes receivable of the 4741, so we zero that out. And now we have interest revenue because we waited a year to receive our money of the 44,000 minus the 4741. So our interest revenue is just the difference between the two, which would be 6% of the sales amount, 4741. So we have 3259. Now let's record the journal entry for our note. So the first thing that we're going to do is there's two ways that we could record the note receivable. We could record the note receivable at the present amount, 40,740, but GAAP prefers the discounted method. So what we're going to do is we're going to debit notes receivable for the full amount, for the face amount, what's called the face amount, which is 44,000. Now what we're going to have is we're going to have sales revenue of 4741. And now what we have is we have a discount on the notes receivable. And the discount on the notes receivable is going to be the 44,000 minus the 4741. So the discount on notes receivable is a contra asset account. so they stick together like glue. Notice they're on different sides, so we take the 44,000, subtract the 3259, and that becomes the value of the note at this point is 4741. Now, what happens on payment date is that Arctic is going to receive cash of 44,000. And the 44,000 of cash is going to take care of notes receivable. So we credit notes receivable for 44,000. Now we have to deal with the interest revenue and the discount on notes. So we're going to debit the discount on notes for the 3259 and credit interest revenue for the 3259. So basically what happens is we're due the whole 44,000, but we defer that part of the interest revenue until the next year when we earn it and we receive the money. So let's work first on January 1st, 2021. We're going to debit notes receivable for the full amount of 44,000. So we're going to credit our sales revenue for the 4741 and discount on notes receivable is going to be credited for 3259. Now let's put in the journal entry for part 2 and to record the collection, which is what I have over here on payment date. So let's take a look at part 2. So on part 2, assume the note indicates that Seneca is to pay Arctic 44,000 and note that it says to enter debits before credits. So I'm just going to enter all of my debits first, cash. And then my other debit is discount on notes. And I have 2 credits, notes receivable and interest revenue. So my debit to cash is 44,000. My debit to the discount on notes receivable is 3259. My credit to notes receivable is 44,000. So I zero out my notes receivable. I no longer have notes receivable. I've zeroed out my discount on notes receivable, and now I just put it into interest revenue. So we've got it all correct, and once again, we did not have to use any of those silly interest charts. I will show you how to use them in a moment, but this is the much more newfangled way to do it. Now we've done parts 1 and 2. Part 4 is very easy because we don't have time value of money. It's just a $44,000 receivable with no interest revenue. But part 3, assume instead that Seneca is to pay Arctic the $44,000 due on the note on December 31st, 2022. Prepare the journal entry for Arctic to record the sale on January 1st, 2021. So this is why I put this first line. In part 3, it's actually a 2-year note instead of a 1-year note. So what we're going to do is we're going to divide by 1.08 to the second power. So if you were doing this on a calculator, you could just take 1.08 and 1.08, multiply that together, get that answer, and take the 44,000 and divide it by that number, but we're going to use the computer. So now let's look at our part 3, a 2-year note. So let's take a look now at our 2-year note. So we're going to use 2 ways to calculate the present amount. The first way is we're going to take 44,000 and we're going to divide it by 1.08 to the second power. So I've just written down the formula. So to do this in Excel, I take 44,000. I'm going to divide by, open parentheses, 1 plus 8%. And as I said, in Excel, we do powers by using that little hat that's shift 6. So I do shift and the number 6. So I get the little hat to the power of 2. And we get 37722.9. So it's 37723 because we're supposed to use the nearest dollar. Now, let's use the PV function in Excel. So in using the PV function in Excel, I'm going to click on that Formulas tab. In the function library, I'm going to choose Financial, and I'm going to scroll down until I see PV. Now that it's 2 years, it's very important that we not put it in the PMT, because PMT would mean that we're getting 44,000 every year for 2 years. We're not. In this one, we're just going to get a single payment of 44,000 at the end of 2 years. So we put in our rate as 8%. 0.08 would work too, because notice that the computer just has it as 0.08. In this case, the NPER is 2, because we have 2 years. And now in the FV, I'm going to skip over the PMT, because we're not getting 44,000 each year. We're only getting one payment of 44,000. And again, in Excel, if I want the answer to come out positive, I have to put in a negative number. And I'll explain that in the computer lab, but it's basically Excel thinks in cash flows. So if I borrow today $37,723, then in the future I will owe 44,000. But if I invest today, which is a negative cash flow, so if I invest the 37,000 today, then I'll get back the 44,000 in the future. I'll do that in the computer lab with lots of hand movements if you don't understand it. So I click OK, and notice I get the same 37,722.91 with the PV and the FE functions. It assumes you're talking about money, so it always gives you a dollar figure. So let's record the journal entry for that one. It's basically the same as this one, except now the sales revenue is 37,723, and the discount on notes is different. So we have notes receivable for the full 44,000. We're going to credit our sales revenue for the 37,723. And then we're going to credit our discount on notes for the difference between the two. So we just take 44,000 and subtract 37,723. So going back to the question, putting in now our part 3, we're going to have a debit to notes receivable. We're going to have a credit to our sales revenue and a credit to our discount on notes receivable. So the debit is 44,000. The credit to sales revenue, 37,723, and discount on notes receivable, 6277. Now let's look at number 4. Number 4 is going to be very easy. So with number 4, if they don't view the time value of money component to be significant, then the receivable and the sales revenue are going to equal each other. In the other parts, we took the note receivable, we allocated part to sales revenue and part to interest. In this case, there's no interest, the entire amount goes to sales revenue. So we just debit our notes receivable for $44,000, and we're going to credit our sales revenue for the same amount, $44,000. We have now finished up problem number 4.